My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is the man who's got a phenomenal first name, Mr. Michael Kramer. Mike, you and I have done a couple of these spaces in the past, but for those who are not familiar with you, introduce yourself. Who are you? What's your background? How'd you get involved in interested markets? And what are you doing currently?
Thanks for having me, and it's great to be on here with you again. I love all your stuff as well. So I've been following the market since I'm about 16 now. So that was about 30 years ago. I've been working in the business. I started interning when I was about 18 on the broker-dealer side of things. Didn't really like the idea of being a broker, so I went on and became a trader out of college, working with venture capital funds and restricted stocks that they own, trying to unwind those positions for them. Then I did some time working in biotech and telecommunication, media, as an analyst, working with the IR departments of companies that were listed on exchanges, trying to be working to communicate what was going on in the market and how it was affecting their stock prices. Then I went on and I went back to trading again and was really there. That was the final stint where I worked working on domestic equities, and then moved into domestic and international equities. I did that for the next 12 years. And then I started my own firm when I was about 36, Ma Capital. And I started off with this idea that I wanted to do, long-term thematic growth investing. And I started the thematic growth portfolio. I raised capital with family and friends. That was going really well in the beginning. And then I kind of reached the point where, you get to real serious investors and they want to see performance and stuff and returns. And I didn't really have that yet. I didn't have a 3 to 5 year track record. So I hit a brick in the wall. And that's when I started writing for websites like Seeking Alpha, Investopedia, investing.com, started my own website with the blog. And from there, I realized people really like, this content of, combining trading activity along with long-term investing, and started the subscription service, Reading the Markets, on the Seeking Alpha platform. Recently just started to expand that out a little bit to Substack to see if I can diversify the audience a little bit. And it was really just last year I started to get involved with Twitter. I know the year before that, many years before that, I had started a Twitter account, but I was really kind of scared of it. But over the last year, obviously, I've had a lot of success with it. It's grown, and I've met great guys like you, Michael, and others. And I've met a lot of great followers, and it's been a really wonderful experience once I've gotten past that initial pain of trying to break into that forum. But yeah, this is fun stuff to do.
By the way, for those in the audience, it is important to stress that for guys like Michael, guys like myself, one thing is managing a portfolio and investing and trading and talking about markets. The other is running a business, dealing with separately managed accounts, like the case of Mike. And I only mention that because, you kind of alluded to it, Mike. It's really hard to grow a business in this industry because you've got to have a track record, which means you need some time. You got to feed your family in the meantime as that track record grows. Oh, and then by the way, you might be starting that track record at the exact wrong point in the cycle with your approach. And that's really hard for a lot of people to, I think, appreciate unless they're actually in the business.
Yeah, it's really hard. And I'll use my personal experience because I, came in, started my, strategy in the summer of 2014. 2015, I was heavily invested in biotech names like Gilead and Alkermes, Acadia, another company called Xenoport. So the way I was running my portfolio, and the way I run it is that I try to I believe in this sort of concentrated portfolio. You keep the portfolio small, keep it to names that you really understand. You have a little bit of an edge in things that, you're enthusiastic about, things that you may even have experiences with. At that time, biotech was really hot, right? And I'm coming out of a background where I understood biotech, or I thought I understood biotech, because biotech is a really hard business to be invested in. That was the peak of the biotech cycle, right? I mean, if you look at the, IBB, for example, it kind of reached a high in 2015, and it took years for it to get back to those levels, right? I think IBB peaked at 130. I'm looking right now in June of 2015. and it didn't get back to 120, 130 again until the summer of 2020, right? So for me, for example, like if you were to go, I run a model portfolio on the Interactive Advisor platform, and a lot of people will go and they'll look at that, and they have the 30-day, 90-day, 1 year, 5 year, and then since inception portfolio. And it's funny because if you look at the performance of my account, my model portfolio over the last 5 years, net, I'm up 74%. The S&P 500 ETF SPY is up 67%. So I'm outperforming over the last 5 years by like 700 basis points, call it. But if you go back to the since inception, which is when I started with Interactive Advisors, which was in July of 2015, I'm underperforming the S&P 500 by like 25% because I started this portfolio on that platform, that model account, at the peak of the biotech cycle when I was basically, max long biotech. And once I got done with the biotech experience, I never invested in biotech again. So when you go and look at it from an investing standpoint, it looks like, oh, this guy has just underperformed but really it had to do exactly with what you're talking about. In that case, it just was really bad timing in terms of the way I constructed the portfolio and the timing of the biotech peak.
Right. And it's always easy to identify this stuff with hindsight, right? Which is what FinTwit is very good at doing. And this is the challenge, right? It's like, so I talk to a lot of, younger people that are in college that want to get into the industry, that are people that want to start strategies, start their own SMA book of business. And they got to do that. But at the same time, they can't control where they are in the cycle. They have their belief system, they have their analytical approach. But it's really challenging to get people to understand that so much of this business really is a function of one's own start date.
Right. And the other problem too is that, you're starting a business and, you decide after, 12 years of getting paid and being in a really good job to go out and try it on your own. I mean, you have, the boss, who's in this case is my wife, right? Because ultimately, I have to provide, even though she has a job. I mean, I still have to be able to carry my own weight. And when all of a sudden, you hit a brick wall, it's like you start feeling that pressure, whether it's coming or not, internally, because it's like, what am I going to do to carry my weight in this relationship? What am I going to do to carry my weight for my kids who are, infants and just, 2-3 years old? So, it's really hard to go out on your own and try to survive in this business, because at the end of the day, you're just one minnow in a sea of sharks, right? Well, who's Michael Kramer? Like, I've never heard of you before. Why am I going to give you $100,000 to invest for me? Let me see your track record. Oh, you don't have one? That's a non-starter, right? And so it's like I had to like scramble and look around, like, what else can I do? What am I going to do to keep the lights on? And it was like, so I turned to writing. And honestly, what sort of interestingly, the reason why I developed this short-term trading mentality in terms of tracking the markets on a daily basis and writing about them is to better pick and choose my entry and exit points in the market for my long-term holdings. Like, I made a conscious decision throughout most of 2020 to not buy new stocks in my portfolio because I had good positions already. I had a decent amount of cash and I was performing well. And I also knew that the period of time we were in wasn't really sustainable for the time frame I was looking to invest for. And the companies I was specifically looking at, I knew the valuations wouldn't be supported in the time where the market actually pulled back, or the Fed raised rates, or the Fed started to pull QE back. And so thankfully I've been positioned that way for the last 2 years.
So let's talk about where we are in the cycle. I was going through some of your Seeking Alpha articles, and you have one that is titled "The Bear Market's Not Over." Now, I will myself tweet that whenever I see the silliness on FinTwit, like around this, PP crypto nonsense that went vertical the last 48 hours. I'm of the same mindset, right? That the bear market's not over. And the thing is, it's really challenging, right? Even the proclamation that the bear market is over assumes that you don't revisit the low. In other words, there's a degree of hindsight with that too. And we don't know if the bear market's over, except, until you hit new highs, which could take a while. Lay out your thesis, right, for the audience. Why is it that you think the bear market's not over from those June, October lows?
Well, I mean, first of all, interest rates today are significantly higher than where they were even in June or July of last summer or October of the fall, in the fall, right? The economy is still holding together despite 500 basis points of rate hikes. Inflation still hasn't completely gone away. I think we got through the first easy part of it. Whether or not, we could get stuck in this 4% area for some time, which means that the Fed is going to be forced to keep rates higher for longer. I certainly don't think you're going to be seeing rate cuts this year. I think it's possible that given all of the stimulus that was created following the pandemic, where nominal GDP grew 25-ish% since 2019, I think that we might just be in a slightly higher interest rate environment than we were in 2020, obviously. I don't think we're going to see rates go back down to 50 basis points on the 10-year. It's possible the 10-year just stays more in a 3-ish% area. You think about where multiples and valuations are. If real yields stay in that 1% range, then the NASDAQ's the most expensive it's been in 15 years. Assuming that inflation does come down, well, that means that sales and earnings estimates are probably still too high and those need to come down. And all of a sudden you're paying, 18 times earnings for the S&P for no growth, which historically is a very high multiple. There's a lot of reasons to think that, maybe the S&P 500 multiple gets back to 16. Maybe that's an area where you put a little money to work, right? Because that's more of a manageable number. But, typically in my experience, bear markets don't end without some sort of capitulatory event. We haven't really seen that yet, in my view. And if you just look at it from a valuation standpoint, the multiple on the S&P 500 is just simply too high for no growth. If we are heading into a recession, which seems to be, again, everyone says there's going to be a recession. I'm not exactly sold on it completely, but there is obviously mounting signs of it. Then if we are in a recession and it comes at the end of 2023 into 2024, then earnings estimates for next year are way too high. And so there you have right there you have a case of getting pretty close back to the lows that we saw in October.
Yeah, and actually that kind of dovetails with my own thinking around this kind of credit events that I think is looming out there, right? Because that would be using your words, your capitulatory type of move, right? The sort of vomit, right. The VIX spike, right? It's like the best time to buy is when a whole generation doesn't want to buy, right? And you're nowhere near that point yet. You and I both know that path is what matters more than the end point, right? So let's talk about time frames. Every bear market has these rallies, like we've seen, right? And you can make good money in those periods. You can make out well, and then hopefully get out at the right time. How do you think through time frames in terms of your own trading? Do you look for certain signals that say, now is the time to lighten up on my longs? Do you look at the length of time the rally has persisted as maybe a sign of exhaustion and a reason to pull back? What are some of the things that you're doing in managing that path?
So this is a lot where the short-term trading analysis comes in that I'm posting on Twitter or writing about. So I'm looking at things like CTA flows. I'm looking at things like option markets. I'm looking at things like technicals and trends. I'm trying to determine, obviously where we are in the cycle in the longer term cycle, but at the same time trying to determine, are we in a short term cycle? So for example, the summer of last year, I had, a bunch of positions in my portfolio I wasn't really crazy about. I had held them for some time. I wasn't really making money in them. They really weren't working the way that I wanted them to work. And I saw we were obviously rallying in August. So I used the August rally as an opportunity to unload those positions, right? I had a very large gain in Tesla that I had bought Tesla in 2014, and I started liquidating it in the fall of 2021. And then by the time of January 2022, I had sold all of it. So I had a large capital gain that I needed to kind of offset a little bit. The one thing I didn't want to do was have people be down in their portfolio and then have to give them lots of taxes as well. So I used August as an opportunity to get rid of some of the names that I wasn't really thrilled with. And I kind of scaled out. As the market went up, I sell a position. The market went up more, I'd sell another position. The market went up. So by the time we got to that mid-August high, I was basically where I wanted to be in terms of that. Then the market came down in that October period. I had cash there. I bought Amazon, right? Then the market started going up again in that mid-November period. I still had gains that I needed to get rid of. So I sold my Roblox position, right? Terrible investment. um, then again, I haven't bought anything recently, but market rallied in February. Also, I also sold Splunk in that November timeframe. And then in February, I just recently got rid of a position in this company called Veradigm, MDRX, because I didn't really like what was going on there. It was like actually mid-March I got rid of that. So again, I've used these rallies as opportunities to unload the positions I don't want and raise more cash so that on pullbacks, when opportunities present themselves, I can be a buyer of something on the way down, or when the valuation makes sense. And what I'm doing there is I'm looking for signs that the S&P 500 is at a reasonable valuation, a valuation where I can say, hey, even if there's 10% more downside from here, I feel comfortable with that because I think I'm getting this company cheap enough that I'm willing to take a risk on 10% downside if I think there's going to be 30, 40, 100% upside in it over the next 5 years. And that's sort of how I've been doing it.
Speaking about valuations, are there certain sectors or industries that you're focusing in on more? I mean, if we are going to have another pullback or correction, whatever it is, are there some areas that look more attractive to you on a relative basis? I mean, the cliche there is, of course, utility staples and healthcare because they're lower beta. But even those, you can argue are still pretty overvalued.
Yeah, so I try to keep things fairly basic. I try to invest in things that I can not touch, but so to speak, I use and that I'm very familiar with. So, like right now, I'm looking at things like cybersecurity, Palo Alto Networks, which has obviously run up quite a bit over the last several months. I'm also looking at things like data providers or things that have a recurring revenue stream to them, like an MSCI or an S&P Global. I'm looking at things like Intuit. I'm trying to look at things that I've either personally used on a regular basis or things that I can see, have some sort of importance where they own something that people want. Like in the case of S&P Global, sounds like a boring company, bond rating agency, but there's only a few of them. Number one. Number two, they have the S&P Dow Jones data set, right? So they own tons of data. And if you want that data, you pay an enormous fee for those data points, which is something I've only found out by using, having a Bloomberg and Refinitiv, wanting to access some of those data points and asking for the subscription price. And that was extremely expensive. And so that's what I kind of focus on. Companies that I own, for example, like I bought Visa and MasterCard in 2014. I bought Visa actually even before that because I just went to Dunkin' Donuts one day in like 2012 and they were like, oh, you can use your debit card here for, it's like a $2 purchase. And I used my Visa debit card at that point to make the purchase. Like there was at one point, if you're old enough to remember, there was like a limit. There had to be a minimum. And once like that minimum sort of vanished, I never really carried cash anymore. So it became really obvious to me that I just need to own these things for the next forever.
Let's talk about sentiment for a bit here, which you can really use FinTwit to get a gauge of, at least at the periphery.
Right.
Right. I
Well,
mean,
you do that very well.
Yeah, well, I happen to attract the crazies, I think, from that standpoint, which is a good signal, but also, it's not exactly good for one's mental health, for lack of a better way of saying it.
No.
I had tweeted that out a few times in the past. The level of uneducated speculation is astounding. Now, you've been in the business for a while. We both know there's nothing wrong with speculation, but oftentimes speculators actually know what the hell they're speculating in. They're not just blindly speculating like I think a lot of the stuff you see on Twitter would suggest. Do you get a sense that we're at sort of another sort of silly season of sentiment? I mean, the crypto side to me is really where it becomes really clear to me, but I'm sure there's other parts of the marketplace where you're seeing some of the inklings of what we saw in 2021.
I see it in the tweet comments, and I see it in comments that, people will leave for me on Seeking Alpha, although I don't usually respond to those comments. You see the comments and you can see the thinking of what people, you can get a sense of what the general thinking of the population is. And usually the comments start revolving around, you should find a new career type of thing, or, you're always wrong, or, and that's usually when I know, like, we're at a, look, nobody's always right. But obviously I must have done something right along the last, 10 years. Otherwise we wouldn't be having this conversation, right? Because you wouldn't even know who I existed. Usually when people really start pushing back on my bearish thesis or my bullish thesis. I mean, right now it happens to be bearish, but from 2015 to 2020, I was extremely, extremely bullish. I will kind of feel it out. Like with my more recent theme has been, the bulls are trapped theme. That sort of got a lot of people going. It attracted a lot of negative sentiment towards me. And that sort of gives me the sense that there are a lot of people believing in this rally, right? And typically, I know that, there's a lot of surveys out there that suggest, bearishness is extreme and the net number of people short the S&P are extreme. But to me, those aren't really fully understood sentiment readings, especially the futures contract one. But the comments tell me that a lot of people are believing that this rally is for real and that there's more upside. And when you kind of think through it and you go through the actual mathematics of the fundamentals, and then you even look at some of the liquidity gauges, it just doesn't add up.
Yeah, and I'm with you on that. Like the AAII sentiment surveys. First of all, there's not really a tremendous amount of evidence, at least from a short-term perspective, that it's predictive. But oftentimes, emotions tend to be sort of your clear contrarian signal. And the thing is, when you think about sort of crowd behavior, you and I both know the crowd is right on average, just wrong at the extremes. Right. So our job, just from a sort of narrative perspective, is to try to identify where the narrative and the emotion is most extreme. And I'm with you, right? I'm short term, increasingly much more negative and bearish. I kept on saying third week of April, I think, is where a correction starts. We'll see, right? I mean, I still think last week may have been, with hindsight, the start of a correction, which sounds weird because we haven't really gone down very much, but a lot of the intermarket stuff I track is consistent with that. What makes you change a view, though? Because this is the other challenge when you're so public, right? So you've got a viewpoint, you've got analysis, gets you to the right of the equal sign, but sometimes, obviously, it doesn't play out, right? You
Right.
and I are wrong just like everybody else. Nobody can predict the future. It's not easy, right, from a content perspective to do a pivot when people say, oh, I thought you were bearish and now you're bullish. But you kind of need
Right.
to have that flexibility, right? Because that's just the way
Right.
markets work.
I happen to think you do that very well. I've been following, I've been watching you a lot more recently because I kind of admire how you have this ability to just say it how it is. I'm a little more reserved, I think, in some ways. It's hard to pivot, right? Because the one thing that I always fear is pivoting and then having my other scenario actually be right and play out, right? Because my fear is, it's like always like that mentality of like, oh, as soon as I want to buy a stock, as soon as I buy it, though, I know it will go down, right? It's the same sort of mentality, I guess. And, the thing is, for me to pivot, and I don't personally do it as much as you do because I don't. You seem to be able to stomach the pushback a little bit more than I can. It's like I can sit here and like fall into my chair some days when I'm looking at some of the comments, right? And I just want to vanish. For me to come out and be like, you know what, this is over, the sell-off is done, I think we go up from here. I need to see a couple of things to really make that case and to really turn bullish. Not like on a short-term trading bullish, but more of a long-term, this sell-off is over and I only see, blue skies from here. I would want to see sentiment turn really negative, right? Where now people are starting to fight you because you're turning bullish, right? That would obviously be a big sort of tell. The other thing, obviously, is I want the Fed out of the way. I don't want to even be talking about the Fed anymore. I would want to see, earnings continue to decline. And I would want to see like these little things starting to show improvement. I remember one of the huge things that I think, looking back on one of my most striking memories of the 2009 bottom was when the March ISM manufacturing report came out. And in that report, the market picked up on the employment index within the manufacturing report was up. It was back over 50 for the first time in forever. And I remember the market went up like crazy. The market started going up crazy a couple of those days. And I remember calling up the guy at Credit Suisse and I said to him, what the hell is going on with the market? Why are we going up like this all of a sudden? And he said to me, well, market improving, ISM employment over 50. That means the bottom for the job market's probably in. And I was like, holy shit. And so once you start seeing things like that, it's like it's time to start getting excited because it tells you that, the bottom has come, the bottom in the economy is here. That means that earnings are going to start to improve again and the market is just too cheap. I'm sure you have things like that you can remember and point out too during that time as well.
It's interesting. I was smiling when you made that point about you change your view because things are changing, but then your fear is that you were right all along and you changed just at the wrong time. So in 2011, and this was sort of my own real kind of claim to fame in the media. In 2011 on Seeking Alpha, I was very adamant in June saying, I think there's a summer crash. I was very dramatic with it. Summer crash of 2011 or the great readjustment. And I was using it to market relationships. And between June of 2011 to the end of July, I put out 20 articles, 17 of which I had in the title Summer Crash of 2011. I was very, very adamant that and I was much more about making calls back then. As I got older, it's more about conditions. But back then I was much more aggressive with this. And then you had the S&P downgrade, the summer crash, Treasuries rockets, S&P goes down 17% in 3 weeks. But there was a period there in the third week of July, and the article's still up there, where I wrote almost a mea culpa saying, you know what, maybe I'm wrong about this whole summer crash thing that I've been very adamant about. And then, basically within a few days after that, I said, you know what? No, I take it back. I'm actually probably not wrong. I still think that it's a summer crash. But there was a moment there where there was like a degree of doubt, right, that you could see in the writings. And I remember back then saying to myself, wow, it's like just exactly as you were saying it, Mike, the emotions that you go through in trying to pivot publicly and then basically catching yourself from committing to the pivot is really, really, it's a very fascinating thing from an emotional perspective, even though, this is about making money, trading, investing, emotion shouldn't be a part of it, but it's not easy to sort of doubt yourself and then kind of go back to your original position.
No. And the other thing too is that, people don't realize when you're running your own business, it's more than just being wrong and making a bad trade. You have something called reputational risk, right? To me, especially at this stage of the game in my career, which is still sort of, my business is just starting to really ramp up because people are finally noticing me after 6 years of 7, even more than that, of being on my own, right? You make a bad call, it could set you back years in terms of where you are in your business development, right? So you can make a bad trade. Yeah, you lost some money. You can brush it off. You come back. You can always get back to. it's a different scenario when you have reputational risk on the line almost every single day. You know what I mean? Like, I think you get that, right? I think unless, I don't know if I'm explaining it right, Mike. Do you understand what I'm trying to say?
I'm with you 100%. No. Yeah, it's that old saying, right? You're only as good as your last trade. But at the same time, when you're in the business and you believe in what you're doing, and you know the data, you believe that cycles come your way eventually. It sets you back, but you have to keep going.
Right. And you know what the most frustrating thing about it is when you get that comment, right? And you're commenting about the cycles. People love to say this all the time. A clock is, even a broken clock is right twice a day. And it drives me crazy.
It's the dumbest saying out there. I used to write for Mark Faber. I'm glad somebody said that. I used to write for Mark Faber of the Gloom Boom Doom Report, and I wrote a whole piece basically attacking that narrative. It's like, if you were to miss your wife's giving birth by 1 minute, you're going to remember that you missed that 1 minute for the rest of your life. Not every minute has the same level of importance in the day.
Well, not only that, but it just totally takes away from the fact that, that it wasn't that basically in my view, what they're saying is that you were right only because you were wrong long enough. And to me, it's like, well, no, I've been trying to tell you this because I've been trying to build a narrative for the last 6 months to tell you that this was what we were looking for, like looking forward. It takes away, for me at least, it takes away the success that I had in making a right call. And not only that, but it to me also sort of, suggests that no matter how many times you're right or how many times you're wrong, there's always going to be people out there that just don't get it.
That is 100% fact. It's like you can't. No matter how plain speak you can be, for whatever reason, I don't know if it's a reading comprehension thing on Twitter or just something about the education system in general. But you're exactly right. You're not going to be able to get everybody to understand your perspective or even the fact that you were right. There's always going to be people that will only hear what they want to hear, and whatever they choose to hear is a distorted version of reality, right? Which I think is just sort of a truism. Okay, Mike, I want to go to the name of the space again, sort of your perspective on global liquidity. So I shared in the nest here, this tweet you put out, global liquidity is going the wrong way based on your model. First of all, let's define what liquidity is for the audience and what goes into that model, and what are some of your concerns there?
So I have this global liquidity model is a combination of the balance sheets of the four major central banks, right? PBOC, the Fed, the ECB, and the BOJ. To be honest, I always used to just focus on the Fed balance sheet. Reserve balances to me were always the most important thing in terms of directing market direction, right? Especially starting after 2020. I struggled for a really long time in trying to understand what the monetary transmission mechanism was between reserve balances and the equity market, because most theorists or most economists or PhDs would tell you that there is no way to transmit money from QE in reserve balances to the stock market, because there's just no way to do it. That's what I was always told. That's what I always read. What was interesting to me was one day I was looking at I had read an article somewhere and they were talking about the explosion in margin debt. And I looked at the chart of margin debt and I went, oh my God, that looks just like the reserve balances chart. How could that be? So I downloaded all the FINRA margin debt data and I ran it with the reserve balances data. And sure enough, the charts overlay almost perfectly. Even the decline in 2018, where the Fed was draining liquidity through QT, margin balances were declining as well. And so what I realized was that somehow banks, through the reserve balances, were expanding and contracting liquidity through how much money they lend through margin and leverage. And that was then feeding into the equity market. And so that became, to me, by the time I pieced that all together, it was probably the fall of 2021, right? I had been working on this actually since 2015, because I had noticed in 2015 and 16, whenever the Fed conducted big reverse repo activity, you would see a decline in the market a couple days later. And so I started to track it many years prior, but I could never figure out what that monetary transmission mechanism was. And that didn't happen until the fall of 2021 when I finally found that article that kind of showed me that chart. And then October of 2022 comes. I couldn't understand where the liquidity was coming from that was driving equity markets all over the world higher, because you didn't see it in reserve balances. They were not increasing. Again, just reading and understanding how markets sort of function, the BOJ really began to intervene in the yen dollar in Forex markets, right? The yen was getting crushed all over the world. BOJ started to sell treasuries, started to sell gilts, started to sell, all their bonds, and they started to buy yen to support their currency. And this led to, a big BOJ balance sheet expansion. And sure enough, if you go and you look at the BOJ, and then also at the same time, China was expanding its balance sheet. I started to look then at these other central banks' balance sheets. I decided one day, let me just put them all together and see what it looks like. And all of a sudden, I put them all together and see what it looks like. And then you overlay it with the charts of many of these equity markets, and they all just line up. And what you're seeing right now is that the BOJ and the PBOC aren't expanding their balance sheets anymore. They've actually sort of declined a little bit. And now you're seeing reserve balances and the Fed balance sheet begin to decline again. And the ECB has also been lowering its balance sheet. So this sort of liquidity that I think comes into the market through leverage is fading. And not only that, but you have these systematic flows, the CTAs and the vol control funds. Vol control funds have been buyers of the market because you've seen realized volatility get crushed because of this tight trading range, which has turned into, implied volatility selling, equity market buying. But that's, I think, due to reverse pretty soon, especially as you start heading into a Fed meeting next week. And you also have the CTA guys that went from being short the market in March to being max long now and have no more to buy at this point. So when you look at it from that perspective, I just don't see any more liquidity coming into this market. And I see liquidity leaving because the liquidity model is telling me that, and because these CTA guys that also help to send the market higher from the middle of March into, call it, last week or so, are going to basically be done.
The cliche response to that would be, that's sell me, go away. All right. And a lot of people use that seasonality, I think about it incorrectly. Sell me, go away is not the idea that stocks go down, but that returns tend to be a lot less and volatility tends to be a lot higher than the best 6 months of October to April. Do you get a sense that that lines up nicely with the idea of just sort of a broader correction happening sooner than not? Liquidity is ultimately what drives everything. It's what drives volatility. It's what drives trends. If that's starting to come out, as you're alluding to, then that's consistent with a lot of the stuff that I myself am seeing around utility strength, lumber to gold, looking like it wants to take another leg lower. You think there's sort of an imminent risk here?
Yeah, I think so. And I know that you've been hammering home on it a lot too. And the other risk here is the debt ceiling issue. If they allow the Treasury to begin to issue debt again, and the Treasury to build up its Treasury General account, which is held at the Fed, and they increase that account by $400 or $500 billion, that's going to drain $400 or $500 billion off of reserve balances at the Fed. That's going to drain a massive amount of liquidity out of the market. And that lines up with exactly what you're talking about in terms of some of these, risk indicators that suggest the market is due for a big decline. I mean, again, depending on when this debt ceiling thing gets resolved or when it doesn't get resolved, that at some point it has to be resolved. And when that happens, that's going to result in a pretty large liquidity drain. And that's going to result in this market moving, I believe, sharply lower.
It's not necessarily something that people should be fearful of, though, right? I mean, it depends on your time frame, obviously, but even in the context of what I keep saying is a melt-up year because it's a pre-election year, you can have just a volatile bull market, presumably, if it's still if the bear market's over, which again, I'm with you, but my point is that you can still have a pretty decent positive return, even in the context of a secular bear market, but just a lot of volatility, meaning a big down, then another big up, then another big down, another big up. That doesn't seem like it's that far-fetched of a scenario. In the absence of zero interest rate policy, there should be more turbulence. There should be more risk for more return.
I mean, you would think so. I mean, QE basically works to dampen volatility, right? Because there's always that buyer in the marketplace. You would see that's why VIX was so low for so long. I mean, then all of a sudden the Fed stops buying and volatility increases, right? The depth of book declines, the spread in the bid and the offer spreads widen, and everything sort of begins to deteriorate in terms of that liquidity. So, I mean, the thing is like, it isn't so much that you should be fearful of a decline in the market, because declines in markets create long-term opportunity. It's how you're positioned going into that decline that can determine, what the outcome is for a person, right? For me, I'm positioned, people always think I'm short. I'm never short. I don't short. I'm a long-only investor. But that doesn't mean that I have to be fully invested at every single moment of my life. Right now, I'm 35% cash, and I'm more than happy to be that in a money market account that's earning, 4% plus. If you're fearful of a decline in the market coming, my mode has been, I'd rather have more dry powder and have it in sort of this higher interest rate, money market account, as opposed to having it invested in the market where there's a lot of questions still. There's a lot of uncertainty. And so that's my hedge. I don't need to be short. I can be in a money market fund and earning a rate of return there. You couldn't obviously do that the whole time, but I mean, that's certainly something that's available to people at this point. The way I look at it is I would welcome a decline in the market right now, because there's a lot of things that I want to buy at some point, and that's what will create the next bull market at some point.
I think that's a good place to wrap this Twitter space up. Mike, what's the URL for your Substack?
Let me look it up, because I don't even know what it is off the top of my head.
We know Substack.com is somewhere in that URL.
Yeah, it's readingthemarkets.substack.com.
All right, so perfect. Everybody, please make sure you follow Michael, show some support to him, and stay tuned. I'm doing another Twitter space in about 8 minutes talking about uranium. Thanks, Mike. Always a pleasure.
Thanks for having me. Great to talk to you.
All right. Cheers, everybody.